There's two things in life that we can't avoid: death and taxes. But what about insurance premiums? Every year when we open our new insurance premium packet that says what check we need to cut, it seems like it continues to go up and up and up. Now, part of our role as an FA is to be familiar with a lot of the different areas of your guys' financial picture. Though we're not licensed in property and casualty, we have a lot of good relationships with both insurance companies and brokers that broker the insurance for you. I was recently on a call with one of our partners out of Chicago called BCU Risk Advisors, and they had on one of the insurers, Chubb. Chubb puts out an annual document called the Wealth Report. And in the Wealth Report, they kind of share different facts, different dynamics, shifting dynamics within the insurance space. So today I wanted to highlight a few of the shifting dynamics, a few of the things that are attributing to the increase in premiums that we've seen really significantly over the last 5 years. I alluded to a little earlier the 15 to 20% increase in premiums that has been fairly common, it seems like, over the last 15 years. I was having lunch yesterday with a friend who owns a local brokerage, and he was telling me they had a handful of people who experienced greater than 20% in insurance premium increases last year. Now let's just define real briefly what insurance is, right? Insurance is there to make us whole in the event of a loss, but it's also there to protect in the case of liability. An interesting fact that came out of the Wealth Report is that from the year 2019 to the year 2022, there was actually, let me make sure I get this right, a 63% leap in individuals or households with net worths over $1 million in assets, right? So there's this increasing level of wealth, which also means an increasing need to basically have greater insurance, which does mean greater insurance premiums as well. Insurance is there to protect wealth, but insurance is also there to protect against liability. And we have seen increased liability in verdicts and renderings, and we'll get into some of that down the line here. But first off, I want to talk a little bit in the shift in mindset, which is increasing people's insurance premiums. Chubb put out a survey to 800 different high net worth families. And what was interesting about this survey is the idea of play hard, right? Work hard, play hard. We've heard that phrase before, and there's a lot of emphasis on the play hard. The interesting thing about playing hard is when you think about what it means to play hard, a lot of the time there's increased risk. Riding motorcycles is a very common one, and it seems to be one that ends up being very expensive if you hit one or are one that gets hit in terms of the verdict that's rendered, right? So this play hard mentality is actually increasing the liability that one carries, right? That the insurer needs to insure, but it's also increasing the premiums. Just because Matt behind the camera likes to ride a motorcycle too fast doesn't mean that I don't have to pay for some of the risk, right? The risk is spread out amongst a pool. So why people may be playing harder, we're also seeing changing weather patterns. Something that I found interesting is they use this fancy word, convective storms, which is just a nice way to say thunderstorms. Right? And I want to make sure I get this stat right for you, so I'm going to look down at my paper here. There has been a 60% increase in thunderstorms that result in damages in excess of $1 billion, right? And that's over, I believe, the last 5 years. So what's interesting about that, right, is we're seeing greater weather events happening. In our case, we actually had the wildfires last year, right? And a lot of the people that were in wildfire zones are seeing increased premiums due to that threat. So it's something that we're seeing here locally. The reality is that over a 30-year time span, ownership of a home, there's about a 9% likelihood that it will be damaged by fire. The greater one is actually flood risk, which is actually in the mid-20s. So moving on from weather, the third and final piece that we're going to touch on today is how litigious of a society we have become, right? Whatever happened to the good old duel? I don't know, right? But that's a joke. Compliance, calm down. We have become a more litigious society, and we are seeing increased verdict sizes, right? And some of that is due to cost of goods increasing, right? To replace somebody's income, to fix their home, to pay for medical coverage for an event, a liability-related event that they hit somebody on a motorcycle like we referred to earlier. Those are going up. What's also happening is this new word called social inflation, dubbed by the insurance industry. So what social inflation is the delta above and beyond what was the anticipated verdict. A lot of this increase in inflation, social inflation, is due to tort reform and litigation funding, which is a really interesting topic if you ever want to Google and go down that rabbit hole. But then also increased verdicts for emotional pain and suffering, right? Also, just the anticipated amounts have increased, and a lot of that can be due to just overall societal inflation in general, not just social inflation. All that to say, the price is going up. The price is going up on goods, the price is going up on liability, so you're seeing increased premiums across the board. Nobody likes to pay these increased premiums for insurance. The joke to start it off was it's the necessary evil, right? Our job as financial planners is to help in any way that we can to make sure that you're sufficiently covered when it comes to protecting the assets that you've worked so hard over your lifetimes to build. So if you have any concern about the premiums that you're paying, or if you're sufficiently covered, or how maybe the shifting market dynamics are affecting you personally, we'd be happy to sit down with you to take a look at what you have. Not because we're going to write any insurance on you, but that way we can help direct you to the person that's going to be the best fit for you in terms of helping you reevaluate what you have. And the last little tidbit that I'll leave you with that I thought was an interesting stat for those of you that are watch lovers, right, is did you know that of all the registered watches and all the registered watch thefts, 44% of them are Rolexes. I don't know too many people that have Rolexes, but 44% of watch thefts that are registered are Rolexes. So for all you Rolex wearers, you be careful. Have a great weekend and look forward to chatting with you next time we see you.